Welcome to the African Allocator Podcast. My name is Chipo Muwowo. My guest today is Roland Gräbe. He's Chief Investment Officer at Old Mutual Multi-Managers based in South Africa. Roland, great to have you on the podcast. Thanks for joining me.
Thank you very much and good morning, Chipo.
Now, I'd like to ask my guests the same question to start. What got you into investing? Can you just say something about your journey to this point?
Yeah, absolutely. So I did not grow up even aware of stock markets and investment management. I grew up in quite an academic household, and I loved math, so I went on to study actuarial science, but I really didn't like the actuarial field. So after completing that degree, I was really looking for a different qualification and something that interests me. And I found the CFA, the Chartered Financial Analyst qualification, and I started studying that from scratch with no idea what a stock or a bond or a exchange traded fund is. But that's where I got my education. And then to break into asset management in terms of getting a job, my first job in South Africa was as a compliance officer in an investment business. So I first did investment compliance and then moved on to the investment team when I finished my qualification.
That's great. And how long have you been with Old Mutual?
I think it's now 15 years, Chipo. So yeah, a good long time.
Brilliant. Now, Old Mutual is a real household name in South Africa. It's a large, sprawling financial group. Tell me a bit more about the specific focus of Old Mutual multi-managers within the wider Old Mutual group.
Yes, so you're correct. Old Mutual is really known as a life insurance company with offices all over in many countries in Africa. And Old Mutual multi-managers, our approach is to create investment solutions by putting together different asset managers. Old Mutual also has what we call a single asset manager, so an asset manager that buys stocks and bonds and run basically select securities. But the difference is we approach investment funds and investment solutions from a different angle by combining skills from different asset managers. And these would be the well-known large asset managers of South Africa, but also some niche global asset managers.
So can you tease that out a bit more for me then? What does that look like when you say you work with these different managers, both domestically and internationally?
Yeah, I think the simplest is to highlight maybe what a typical multi-asset or balanced fund solution would look like in our books. And so you'd find 5 or 6 South African equity managers, 3 South African fixed income managers, 1 or 2 listed property, maybe some cash management or money market. And then the global managers, we appoint some specialize in global equity. So it's a global equity mandate. We also have global listed property mandates, global cash, global bonds. And then we do distinguish between developed and emerging markets. So in our framework, there's global, which is really worldwide, excluding South Africa, or South Africa is negligible in that. Developed markets, emerging markets, and then South Africa we see as our domestic market, even though technically it's a small emerging market. In our portfolios, it has got quite a substantial weighting. And maybe just last thing, peculiarity about South Africa, we have exchange control limitations and what we call prudential guidelines. So we're forced to some extent to invest more than half our assets in South Africa for any assets that are part of the retirement savings network.
Mm-hmm. We'll go into your exposure to different asset classes and things in a bit more detail in a moment. But just zooming out a bit, what are you trying to achieve for your clients? So really I'm asking about the kind of vision behind the allocation strategy.
Yeah, I love that question because that really speaks to our purpose. So all our investment processes start with a desire to grow people's money in real terms. And what I mean by that is we build investment solutions to beat South African inflation for South Africa investors, or if it's a global strategy for a global investor in a hard currency. What that means is we target inflation beating returns. For example, we say we want to beat inflation by 4 or 5% per annum. What risky assets do we need? How do we diversify? What is the probability of success over a 7 or a 10-year period? How do we increase that probability? That really is the impetus behind our investment strategy. So we want investors not to think about beating a market or a peer group, but really to grow their wealth over time through asset allocation, manager selection. And really, we're trying to match that need with the appropriate amount of risk to reach that objective.
Tell me more about your asset allocation then. So what kind of asset classes are you exposed to? So if you break that down for me, and then maybe we can talk about regions as well. That'll be really good.
Yeah, so I don't want to make this sound too complicated, because in my head it's really a simple thing, but we do allocate to a lot of different asset classes. So I mentioned the South African and global asset classes, but these are just the listed traditional sectors that we invest in. And the majority of our investments are in listed instruments. So equities and bonds that change on national exchanges. In addition, though, we also invest in hedge funds in South Africa. So we've got exposure to quite a few. In fact, we run our own fund of hedge funds, which combines, quite a few different single managers to hedge fund strategy. And then there's a host of other alternatives in our portfolio, infrastructure bonds, what we call hybrid equity, which is really that's a difficult one to explain how it works, but unlisted bonds, unlisted equity, private equity, we've got some exposure, but these are all high risk, so we diversify them quite widely and we hold quite a small proportion of it. Globally, we're still a little bit more conservative. So we, for example, we don't have global hedge fund exposure at the moment. The one thing that I'll mention that's interesting is we are trying to provide liquidity, right? So we also run what's either called unit trusts or mutual funds in different countries. And those require daily liquidity. So the asset classes that we don't really get into is the most illiquid. For example, direct property. We don't invest in direct property to any degree, preferring in most cases the listed liquid alternatives.
When we spoke a few days ago, you mentioned that you have, over time reduced your exposure to some African listed equities, and I guess the liquidity is probably the main driver behind that. But could you explain a bit more about that? And am I right in saying it was African, not South African, or was it South African, not African?
Yeah, let's get into that. So I've been in this industry 25 years, and as you know, some things definitely go through cycles of popularity and not. And I think African listed equity has been through at least 2 cycles. Often the trend starts with economic analysis, projections about economic growth in a certain region, then excitement, then fund managers start exploring the region. They find listed equity at very attractive valuation, build funds, perform well, attract capital. Now, Africa as a region has gone through a bit of a boom and bust cycle. I would say it was about 10, 15 years ago. It was quite prevalent to set direct mandates for African listed equity. But there has been some challenges, especially during the global financial crisis when liquidity disappeared from most emerging markets, quite frankly. So we have had exposure to African listed equity. At the moment, we don't have an active mandate. But if you look in South Africa, there are 7 or 8 funds that I'm aware of alone that run pure Africa listed equity mandates. And as you said, there are 2 types. Some exclude South Africa, so they build it as a diversification strategy for South African investors. And others look at Africa as a region, and South Africa would have a fairly sizable exposure because of its large and liquid market. I must say, for equity investors, the most attractive markets are the least efficient, least traded, most undiscovered, because generally speaking, equities can be bought at really, really favorable valuation, and returns generated can be fantastic. To my mind, there will be more cycles like this. I think as the world allocates capital, at the moment, a lot of capital is trapped in the US, and there's a lot of skepticism about China and emerging markets. These trends do rotate and shift. And I think there will be a time again for African equity to shine. But what you want is kind of a global concerted capital looking for a return to inflate those markets. And then in terms of challenges, as you mentioned, I think two big things. One is, and this is a chicken and egg, you actually want a lot of liquidity in your equity market to encourage you to invest. But that investment creates the liquidity. And so it's difficult to move from a low liquidity market to a high liquidity market. It's doable, but it takes time. So liquidity is an issue. And then, as you might be aware, for a global investor, it's really important that they can repatriate their capital in hard currency. So to get money out of the country in US dollars, in euros, that's been a challenge in some African countries where shortages of foreign currency do exist, especially if that country has got quite a lot of dollar-denominated borrowing. Yeah.
You said something interesting there about how the markets with low liquidity can be quite attractive because valuations are so low. Those markets being attractive sounds a bit counterintuitive. So how can an investor, approach markets like that, where yes, they can pick up, different companies for not very much, but they're not going to be traded in and out, regularly. What kind of mindset, what kind of approach do they need to, be invested in those markets and, hopefully derive a return at some point in the future?
Yeah, I really like that question. So by way of a practical example, I'm not going to call on a specific stock, but let's just say in an African country, you might find a cigarette tobacco company, and they might trade at 2 or 3 times their free cash flow. In other words, they're generating so much cash that the price you pay for the share will be returned to you 2 or 3 years down the line in dividends, without any good things happening, no re-rating. Okay, so that's the typical attraction of looking at markets in Africa, is you do find stocks that trade that cheaply, fraction of their net asset value, fraction of their book value, etc. So that's the attraction. Now, to get the return back, it's difficult to make general rules, but what I would say from a general perspective is, as an investor, you need to have a very, very long time investment horizon. You cannot be in a hurry to sell, and you cannot ever be a forced seller. And what I mean by that is you don't want to sell when news gets worse. You want to sell it when news gets a lot better. And so for South African equity, we think that to be committed to the equity market, you probably need a timeline of about 7 to 10 years in order to have confidence in getting that, inflation beating solid return with a high probability. I would just say for African equity, one needs to add a little bit of a risk premium to that and a little bit longer timeline. So let's say 15 years. Now, 15 years is a lifetime, right? Can we imagine selling our share in 2040? Well, I think if you sell your share in 2040 that you bought today, that you just left alone, you will make large multiples. And then the other thing is, in bond markets, you want to be big, you want to be a bully, you want to, throw your weight around. In equity markets, I think it's better to be small so that you're really just a slither of the liquidity of the day, so that you can basically sell your entire holdings in one day without impacting the market. So I would say stay small, long investment horizon, And you need to be counter-cyclical. You need to be a buyer when nobody else is buying, and you need to be a seller when everybody else is buying.
Yeah, that's really interesting. In your view, what are some of the key ingredients that make a good investment outcome? So you're seeking to deliver good outcomes for your clients. What are the key ingredients that need to be in place for that to happen?
That is a fascinating question, because I think the first argument I make is that some of the key ingredients come from us as being responsible for the investment, but there are also some key ingredients on the client side to make this joint endeavor successful. And it's very important. The money we manage is other people's money, right? We're not some company managing its own assets on its own balance sheet. We're taking what we call third-party investors, but it's human beings giving us their capital, seeking a return on it. Okay. From the client side, I think there needs to be alignment in terms of the risk and the return and the objectives. True alignment. So what we're trying to do and what the client wants to get from the investment need to be aligned. So when I say we build an equity portfolio with a 10-year investment horizon, a client is well served to invest in this when they truly have a 10-year horizon, when they're not going to sell 2 or 3 years down the line, or the average client at least, let's say that. So we need alignment between both parties. Now, when it comes to all our obligations to be successful, I think one is we must know what our investment approach and strategy is. And although it can evolve over time, it shouldn't evolve out of crises. So you need to know before a financial crisis or a currency crisis hits you, how you build a portfolio and what will happen in that environment and how you will get through it, protecting the capital, compounding returns. The plans need to be made in advance. I think investment strategies fail when they only adapt in moments of adversity. So when markets fall, they try to shift or take more risk or take less risk or time the market in and out. I think successful strategies foresee the expected risk, cater for that, build in diversification, and then effectively you want to back all of this up by proven, well-researched approaches, sound, unemotional, even back-tested quantitatively to model whether this really works and whether it will work in different scenarios. So maybe a bit too technical on some aspects, but broadly speaking, that's how we think about it. And I think the one key takeaway is unemotional, because I think human emotion and the investment cycle is fundamentally incompatible. And we actually see it in our market, If you look at the average investor buying unit trusts, they miss 2 or 3% per annum in returns by moving their money around. So they effectively reduce the success of their endeavors by trying different things. And typically it's by allocating to funds based on past performance. That human thing. I mean, why would you bet on the slowest horse? You want to bet on the horse that won the previous race, but in investments, that's often the worst strategy.
That's really interesting. It ties in with a question I was thinking about around how often you revisit your strategic asset allocation. So, you set this process in motion, you've done all this research, you've run the numbers, and you said, right, this is going to be our strategy. But how often do you revisit it?
Yes. So we think in terms of two concepts. The one you mentioned, strategic asset allocation, is really, it's a fancy way of saying our default normal portfolio. And let's say this portfolio has got 50% in global equity and 50% in South African equity. So an easy 50-50 split, local equity, global equity. That would be our strategic asset allocation. Right now, we might be 55% South Africa, 45% global, and that we call our tactical positioning. Now, the first one, the 50-50, that really defines the risk we take and gives the strategy a certain risk return. We don't want to mess with that. And it ignores the environment. It ignores, interest rate levels. It's really a policy we set for the long term. Let's call that for the next 10 years. The tactical position is really dynamic. That is driven by, what's happening in the world now, which currencies are strong and weak, which economies are performing, where is interest rates. So that's the tactical position. We don't trade in and out of markets on the regular. So typically, if we have an overweight to the South African market relative to global, that's probably a 2-3 year view, or if something fundamentally changes. And so we stay in those tilts for quite a long time, and we increase it and decrease it. But directionally, it's really on the basis of, in the currency that we target, what is the more attractive investment? And we just lean into that slightly. There are situations where you have to rethink your framework. For example, if laws change, let's say if we were allowed 30% outside the country and that changes to 45, then you basically need to redesign, because now you can set a more optimal portfolio. That's one scenario. Another one is if you say, look, exchange traded funds are coming through, hedge funds are proving their worth, there's a lot more liquid alternative investments available. Can we build this portfolio even better by adding other asset classes? If we say yes to that, then we change it in our strategic allocation so that our default product, the thing we sell, the thing that investors see as our normal portfolio, we would change that as well.
Yeah. So it sounds like you would revisit it when there's some, I don't know, mega trend or some significant shift, structural shift within the market. Is that correct?
Yes. And I think the key thing is it's not really driven by macroeconomics and all the things people talk about. It's really driven by, has the opportunity set fundamentally changed? Just to give you an idea, in order to do asset allocation, you need to have some kind of expected return in the model. You also need a risk model, but I won't go into that. But part of it's expected return. We use for South Africa 110 years of history to help us understand the risk of the market, the expected return, and also how sensitive it is to other markets. So we like a long-term history. We like to capture all the weird things that happen in different markets over time, because in different market crashes, asset classes behave differently. In global financial crisis, bonds might have held up, but in South Africa at least, in the COVID crash, South African bonds and equity was extremely correlated. Sometimes the dollar is the safe haven that people rush to. Sometimes it is the start of it. And so you want to capture all of these risk dynamics in a market when you model portfolios.
Coming from an academic background, that must be quite stimulating.
Yeah, I must say I do. I enjoy a bit of maths and statistics and actuarial modeling, and I'm surrounded by a very strong team. We're about 10 people, many of us CFA chart holders. There's some master's degrees kicking around. And I must say, when we're trying to model and think about risk, we're not shy to look at scientific white papers, but one can be too theoretical.
Sure.
You have to couple that with experience. And in my team, I would say the average experience is probably around 15 years, if not more, in this type of investment framework. So if you've got an appreciation for the theory, lots of real market experience, then you can possibly put it together in terms of an effective investment strategy. Investment strategies and investments are really hard. There's nothing easy. There's no easy money to make as an investor. I think if you think there is, you probably in the wrong investments. There's a global competition for capital. Markets are incredibly efficient in their pricing. The only people that make steady money are the people providing the shovels. So what I mean by that is the stock exchanges, the stockbrokers, people who partake in the act of investing by providing services, they earn a steady income. All other investors are risking capital, and it's a challenging thing, the market, you're pitting your skills against the rest of the world in a way, because for every buyer, somebody needs to sell. So it's a difficult thing and not something to be taken too lightly as well, I think.
I want to talk about your approach to manager selection. What do you look for in managers?
Yeah, so I mentioned that past performance leads most investors into difficulty. And what I mean by that is basically looking at people's track records and the guys who perform the best, you give them your money. We do look at past performance, but we have to dig quite a bit deeper to know whether that past performance gives us some confidence in skill. So we have quite a structured manager research process. So we apply the same metrics, questions, principles to anything we look at, whether it's a local equity manager or global. And there are a few things we look at. Are the people that did well in the past still part of the team? So you can't just look at a fund and say a fund performed well, right? Behind a fund, there are people. And when those people change, very often the risk and the performance signature change. So we look at the people, skill, experience, track record, continuity of people. We look at their investment process and we talk to them about the investment process. We ask them how they think they do better than the market. In what environment do they do well? In what environment do they struggle? So what is their best market? What is their worst market environment to operate in? And we look at their investment thesis, their philosophy, the theory behind their success. Does it make sense? Does it exist in other markets? Are they better at doing that than somebody else? Then we look at the performance, and we don't just look at the performance, we look at the risk they take to and that performance. So you can imagine this is really a matrix of many questions. We think of it as two categories: quantitative, so looking at performance and risk measures of the past, and then qualitative is looking at all those business elements. I think one important one is how strong is that asset manager as a business entity. We don't want to be their largest investor. We don't want them to be too small so that they might go out of business. We don't want them to be too big so that they only trade in the most liquid stocks and they can't take views on small stocks. So it's balancing all of those things. And only once you've done that and you've rated a whole lot of different managers, can you try to build a portfolio. And often in a country, some of the best managers might be doing the same thing. And you don't want managers in a portfolio that do the same thing. So then we start looking at how do we get the best guys that do things very differently, because we want them to diversify each other. We don't want them to go to do well and badly at the same time. That's broadly it.
Yeah, no, that's really interesting. I'm also kind of curious about your take on active investment approaches versus passive, and how that shows up in your manager selection process.
Yeah. So I think this is a global theme, and anybody with a global perspective would know that I think the US is leading the charge, but active managers are shrinking at the cost of ballooning passive funds. You know, the likes of Vanguard, BlackRock has become, I think one of them has got $3 trillion assets under management. It's a number that I just cannot get my head around. How much is $3 trillion? I just know it's unthinkable. And so in terms of global trends, people are giving up on active asset management, or at least as passive management is becoming the preferred way to invest. And I think there are good reasons for it. One of those reasons is it's very difficult to find skilled active managers. I mentioned they're not all skilled, they cannot be. They represent both sides of the market. They cost more, but I think the kicker here is it's not so easy to know which asset managers are skilled. Okay. So in terms of our investment portfolios, we use both. And so we have different types of active managers. Some use quantitative methods, others not, and different investment styles. but we like having some exposure to key indices, market cap, a global index tracker, a South African index tracker. What that brings in the portfolio is quite a few things. Passive investments bring you close to the market return at a very low cost. That's a good thing. It also allows you to control your risk a bit so that you don't out or underperform that market too much through your active manager. So it dilutes your coffee to be a little bit weaker. So less boom, less bust. That helps. And then lastly, we sell our solutions as funds, and including passive brings the fixed cost of investing with us down considerably because there's no research process needed. And the fees are lower. And we don't have to charge some kind of margin for work we do to evaluate it. So bottom line, I would say in our total book, index type investing probably makes up about a third, and 2/3 is active management. There are some markets where there is no passive alternative, for example, all the alternative asset classes. And we do find that especially South African equity and other asset classes, not highly efficient. Active managers tend to do pretty well if you select, decent managers. So that would be our split. And we're quite keen on both. We think there's a place in the portfolio for pure passive, for enhanced index, fully active, different styles. There's a lot of ways in which you can outperform the market.
The growth of passive is one way the industry has changed over the last, 2-3 decades. What other ways has the industry changed during the time that you've been involved in asset management?
So I think it's a slow evolution. I don't think it's been massive disruption or fundamental change. And in fact, a lot of the alternative asset classes I mentioned today was equally available to us 25 years ago. I mean, private equity and fund of funds in private equity is not new at all, locally and globally. There are a few interesting things that have come about. I mean, I don't want to push the conversation into the direction of cryptocurrency because I'm a huge skeptic on this topic, but people are talking about cryptocurrency still and wondering whether it is an asset class or not. But I think the sophistication around currency is actually quite interesting. We can now buy any asset class hedged to any currency. So we can decide that our global equity returns, we don't want the South African currency to play any role. So we can invest in a fee class that brings those returns back to us hedged. And not just equity, bond funds as well. So global funds with different currency classes fundamentally changes portfolio design and risk. You can actually choose your market and your currency. So I find that very interesting. There is a very liquid, very efficient currency hedging market. Hedge funds, have they fundamentally changed? I think not. In South Africa, they've just proven their worth through the cycle. So the South African experience there is good. There's a bit of a sad note, but regulatory compliance and the activity required to satisfy regulators has increased probably 30-fold. The number of people we employ and the hours we spend to measure, report, attribute to regulators is almost threatening business longevity. And this doesn't just impact asset management, also financial advisors, other industries. When you spend an increasing proportion of your profits on regulatory matters, that's just cost, right? And I really believe in effective regulation, strong ethical governance. And I don't argue for self-regulation or a free-for-all at all. But I think the majority of these activities doesn't actually reduce the risk of investors falling for scams unethical behavior and so on. So I would say the cost of compliance has increased massively and not with the commensurate benefit. And then lastly, I do think the structures, the way we invest, the vehicles available to us is changing a lot. You would have heard of exchange traded funds. That's not so new, but actively managed exchange traded funds, that's pretty new. That really increases options. And so the last thing I want to highlight is the evolution of platforms. So the example I'll use is a business inside Old Mutual, which started off in the traditional stockbroking place. So they were able to buy specific shares and build a portfolio for me. Over time, this developed into an online app, then became the functionality that I could buy my own shares and sell my own shares in the market in real time at a very low cost.
Mm-hmm.
Then you start adding a huge list of global exchange traded funds. And now I can invest anywhere in the world. I can execute the trade myself. And still, I'm not really paying much for it. In fact, I'm getting the benefit of efficient currency trading, not like through banks where there's a ripoff. You get the spot rate, low admin charges. So through the internet, through applications, through stockbroking license, etc., this has become a more sophisticated marketplace than what the industry was at maybe even 10 years ago. And so for individual investors, but also for institutional investors, trading, investing efficiency, lower cost, access to everything, everywhere, real-time data, lots of data to research, and then artificial intelligence coming in saying, oh, you've got 1 million reports to go through. Let me do that for you. Let me summarize it for you. I'll only lie once or twice if you're lucky. Those things are fundamentally, they are changing our world. And perhaps, I'd say it flippantly, but I think artificial intelligence is the big disruptor in this game. We make use of it in our business in various processes. We also avoid it completely in others. But people like the London Stock Exchange, Microsoft, they have an AI partnership that's producing, I would say, wonderful applications to financial services industries. And there are others competing as well. But AI will turn big data into key insights for us very quickly and very reliably. There's some things that large language models and other AI applications do extremely well, better than a team of humans. So yes, it excites me, and it's nice that there's innovation. We don't want to be stuck in the same routine for 25 years. But yeah, the asset management industry, it will evolve, right? It will always evolve.
Yeah, absolutely. Just one last question. As you look ahead to the next 12, 18 months, what key data are you keeping an eye on? So this could be from a macro perspective or investment industry. Yeah, anything interesting.
Yeah, so as a bit of a scholar and as a, let's call it a efficient market participant, I think about the US yield curve a lot. Effectively, most assets derive their value from some kind of theoretical framework. And you start with what we call a risk-free rate of return. What is the return you can earn on capital taking the lowest risk? Now, the whole world has for many, many decades taken the US interest rate as that risk-free rate, saying this is the safest, biggest economy. They were AAA rated until recently. So with the US, I guess, becoming a more risky market, it's actually putting a question mark on the fundamental framework of valuing assets. And the changes to that, the move of that yield curve, but also the trust in the US market as a proxy for safe haven. That I pay really close attention to. And then there's some other things that's important. In South Africa, we care about the commodity cycle. We're a commodity exporter. Our economy is really influenced a lot by commodity prices and Chinese economic growth. I'm also watching economy of China relative to the economy of the US, and the fact that the stock markets are such different beasts and differ so much in size. Right now, US companies have a huge weight in a global index and China very low, but their economies will at some point swap sides. I mean, there's no doubt the Chinese economy will be bigger than the US economy eventually. So that's a big fundamental shift. Maybe we should be designing a global equity portfolio around Chinese stocks at its center and US, Europe, Japan, and others around it. I'm saying it to be a little bit controversial, but I think people should challenge themselves and say, there are things changing around us. What are we doing just because it was done like that before? And what should we be doing if we imagine the future in 5, 10, 15 years? Because that's our investment horizon. We should think of what the world will be in 15 years' time. Yeah. So, and then currencies, I mean, we really care about currencies, which currencies we think are strong or weak and why. And then different stock markets. Are they trading at, very expensive levels like the US tech sector, Makes a big difference if you pay a multiple of 200 for a company or two on your subsequent returns. So, yeah, we follow that. A lot of it's macroeconomic. That is part of my job as an asset allocator. And so we look at economic shifts, policy shifts, but we also look at that bottom-up valuation of what are markets pricing in today.
What about in the South African market? Are there any things that you're keeping a close eye on?
Yeah, so in our view at least, and this is a subjective assessment, is we think that our equity and our bond market reflects already a lot of risk in South Africa. And as a result, our equities are very cheap in terms of their valuation relative to history. Our bond yields are very high. When our long bonds are trading, around 10%, which in global terms, it's high. Our inflation is low. It's sitting below 3%. So, I mean, an SA bond with a 10% yield and inflation at 3%, that's a 7% difference. 7% real return over the next 20 years. Man, that would be lovely, right? So we ask ourselves, what is the market pricing in? Is it saying South Africa is over-indebted? Will inflation, break out and destroy returns? But yeah, South Africa's market's interesting. I would say foreign participation and local investors are about 50-50. So both are very active in the market, but they bet on different things. I get the idea local asset managers like valuation. So they want to buy cheap, they want to sell expensive. And you can't generalize like that, but I will. I think foreigners like a good story. So I think for many foreign investors, they want to see GDP growth, healthy demographic, falling interest rates. They want to see the macro picture take shape first. And they often exhibit more momentum. So they like to buy things that go up.
Sure.
South African asset managers tend to like to buy things that have gone down. So that would be a contrast that I would say in our market.
Yeah. That's really fascinating. And sadly, this is the end of our conversation, Roland. But thanks so much for joining me on the podcast. I've really enjoyed talking to you. And appreciate it. Thank you.
It's a huge pleasure, Chipo. And hopefully we can do it again. Maybe we don't have to wait 15 years. I'd like to chat to you again soon. But thank you very much for the opportunity. It was a wonderful discussion.
Great. Thank you.